Hello, I'm Mike Graham, the president of Midwestern Securities and your host of the Banking on Growth podcast. With us today, we have Bill Chittenden, who is a PhD and the CEO of the Southwest Graduate School of Banking and SMU Cox School of Business. Bill, thanks for being with us today.
Well, thank you for having me, Mike. Appreciate it.
Yeah, I'm looking forward to our conversation. Will you tell our listeners a little bit about yourself and your organizations to get us started?
Sure. So very quickly on myself, I started as a banker. And so many folks say they were accidental bankers. I was actually more of an accidental academic. So I started my career at Norwest on the consumer side. Absolutely loved the first couple of years of it. And then the culture switched to it was very much a sales culture. And I hated it. And because I wanted to do what was best for the customers, not necessarily what was most expedient for getting a sale done. And while I was doing that, had been working on my master's at night, got to know the faculty, saw that their lifestyle was kind of nice, not a whole lot of heavy lifting, and was told that I had the ability to explain complex things in more simple terms for folks. So I had a great study group, and they said they liked to study with me because I could explain things well. And I figured if I could explain things well, then I must understand it. And so I decided to go get my PhD. But I've been fortunate my entire academic career to keep one foot in the banking world and one foot in the academic world. And so for 24 years, I'd served as a faculty member, department chair, associate dean for graduate programs at Texas State University down in San Marcos. And then for the last 24 years, I've been teaching at the Southwestern Graduate School of Banking. And then when my predecessor, Jeff Schmid, was tapped to be president of the Kansas City Federal Reserve Bank, I was selected as the eighth president of what we refer to as SWGSB. And so at SWGSB, we educate community bankers and community bank directors. So some of the programming that we have aimed towards community bankers, kind of our marquee program is what we just simply refer to as SWGSB, or the Southwestern Graduate School of Banking, where it's an on-campus program. Bankers are on campus for 2 weeks for 3 years. And then between years 1 and 2 and 2 and 3, they have a couple of projects that they work on related to their bank. And if they've approached the projects correctly, they've got recommendations that they can take to either management or the board and say, look, I just, for example, looked at our asset liability management policy. Think in these areas we're doing great, and maybe we could change things up a little bit. And so it is extremely practical for them. And so our typical profile for that is a banker that's been in the industry for 7 to 10 years, and they've been identified as a future leader of their bank. And so that's why they're being sent to SWGSB. Kind of the joke is, if you ask a lender, what do you know how to do? Well, they know how to make loans. If you ask a lender, where does the money come from for the loans that you make? A typical response is, magic, I don't know. And so our objective is, regardless of the area of the bank that you come from, and we have folks from all areas of the bank, you understand how all of those pieces fit together. And so if you're a lender and you know that you've got a goal of 5% loan growth this year, then you've got to have some type of strategy on the funding side to fund that 5% loan growth. None of these things happen in isolation. We've got programming for those early in their career. We just concluded our commercial lending school on campus, where folks are here for a week. Again, those early in their credit career, credit analysts. And so we had 116 bankers from 15 different states, getting educated by some of the best practitioners and faculty in the country. And then in just a few weeks, again, we start SWGSB. And then we also work with the Independent Bankers Association of Texas in their Bank Operations Institute. So we've got educational opportunities for folks from all parts of the bank. And then we do our director education, where on campus we have our Certified Community Bank Directors program, particularly for new directors that might know a lot about their business, but they don't necessarily understand how banks work. And so our job is to get them up to speed on what the responsibilities are for bank board members. The regulators are looking at what those board members are doing very closely, and board members simply saying, I didn't know or I didn't understand isn't sufficient anymore. And then we have our assemblies for bank directors, which we hold around the country twice a year. We have one generally, end of August, beginning of September. Our next one will be September 1st, 2nd, 3rd in Newport, Rhode Island. And then next winter, February 1st, 2nd, will be it's a tough job, but somebody's got to do it. We'll be in Oahu, so we'll be going to Hawaii again. But it's great. The bankers come, they get to hear from some wonderful speakers. Our last keynote was Lori Logan, president of the Dallas Fed. Prior to that, we had Mickey Bowman, who hopefully will get the confirmation as vice chair of the Federal Reserve. So we've got some pretty good speakers that come out to our assemblies. So that's, I know, a bit of a big nutshell, but that's what we do at SWGSB.
Yeah, that's a lot. That's a lot. So community bankers, bank leadership has to, as you mentioned, they have to have a global understanding of their bank, of their space, of their place in the competitive market, and their place in the regulatory market. And so your programs, sounds like, really educate them, broaden their horizon, make them a better leader. Do your programs touch on non-interest income sources? How do you manage a wealth management division, for example? Or how do you buy insurance agencies and manage salespeople inside of it? Do any graduate school of banking programs get there to that next level of non-interest income and financial services beyond the traditional side of the bank?
Well, I can't speak for the other graduate programs, and there are several other great ones around the country. Of course, in your area, you've got Madison, Wisconsin. They do a great job up there. Out west, you've got Colorado, LSU, you've got Stonier, you've got Pacific Coast up in Seattle. And the core of what all of us teach is similar. One of the things, though, that we do at SWGSB is during their second and third years, they have an opportunity to select 5 different electives per year, and they have generally 25 choices. And so those electives will allow them oftentimes to get into some of those more, if you will, niche areas that will match up with some of their interests in terms of, right, what are the keys to having a good wealth and trust area? Looking at, as you'd mentioned, what are other potential sources of non-interest income for the bank? And so we do have opportunities for the students to dive a little bit deeper into those areas if that's what they're interested in. So there'll be things, anywhere from how to work out problem loans to what's happening in terms of AI and banking right now in terms of the breadth of electives that they have to choose from.
That's good. Thank you. So the people that enroll in your programs are they're pre-qualified. They want to grow. They want to be they want a bigger future. They may be more open to new ideas, more ambitious than their peer banker, right? So I would assume we're getting the up and comers, kind of the best of the best, are going into graduate school of banking, not people that are complacent or comfortable with the status quo. So we're pre-qualifying. We've got people that are more receptive and want a bigger future. Can you put your thumb on a couple of key attributes of those types of bankers? How does a aging bank board or bank leadership identify some of those up and comers? What are some key things that they should look at? This is a young professional that I want to invest in and I want to get into your program.
Well, my hope is that those bank leaders are already seeing those things that distinguishes somebody that would be quote unquote SWGSB material from the other folks. And so a banker once told me to ask someone, do they just want to work at a bank or do they want to be a banker? And I think you can tell oftentimes from the work ethic, from when there's a need for something, who's raising their hand and saying, let me take the lead on that, or let me help with that. Those are the folks that want to be bank leaders, as compared to the ones that are just watching the clock. Okay, it's 5 o'clock, time to punch out. And so again, hopefully it's one of those things that's obvious to leadership in terms of who the potential future leaders are. They're the ones that have demonstrated, curiosity. Why is it that we do these things? They're looking at other areas of the bank that maybe that's not their silo, but they, gosh, what do those guys do over there? Why is it important? Why do we even have these compliance folks when they keep telling us we can't do all these things? And so I think those are the types of folks that if there was one word, I would say curiosity would be what captures them, but not in a in a flippant sense, but folks that are really wondering, how do all these pieces fit together? What's the next thing? And along with that, you've got to have the work ethic. It's a big commitment for a bank in terms of time and money to send somebody to a graduate school of banking. And I don't think any of them take that decision lightly. And they look at it as an investment in their bank's future. Now, I have heard, sometimes some bankers will say, well, what if I've got these people and I train them up with SWGSB and then they leave? And so the response is, what if you keep them, you don't train them, and they stay?
Right.
So that's the
Right.
alternative is, you can keep folks and not train them, but then they're going to want to leave to go someplace that is going to invest in their future.
Yeah. Yeah. I love it. I love the thought of curiosity and entrepreneurialism. Curiosity and entrepreneurialism, I think, go hand in hand and come with a higher level of passion and a desire to win, desire to dominate in the marketplace, rather than just promoting the CFO to the CEO suite or the COO. Sometimes that's merited, but sometimes it's bring in somebody with more curiosity and a bigger vision for learning more about the institution and the institution's potential to grow.
Exactly.
Yeah, I like that. So what do you think is the top of the mind of bankers these days? There's a couple of things, right? A little bit of news and uncertainty out there.
Well, that is I think the word of the day. A few years ago, transitory was the word of the day or the word of the year. At least for 2025 right now, I think that the word is uncertainty. And in fact, was just at a conference with a bunch of bankers earlier this week, and that's the major thing that's on their mind is all of this uncertainty and how is it going to affect their customers' ability to repay them. So it's not unusual in Texas, at least, to have a lot of ag bankers. In the Midwest, my guess is it's very similar. And with the tariffs, you've got these increases in cost for fertilizer, which is a direct input, obviously, for the farmers. For those that are growing soybeans and rice and wheat that we've been historically shipping to China. China's not buying them right now. So all of a sudden, for some farmers, all of their customer base has evaporated very quickly. Now, is it just a temporary thing? Is it going to be permanent? That's the uncertainty that has these folks concerned. A lot have said in terms of their C&I lending, a lot of the customers just want to kind of sit on the sideline right now and see what happens. Should we be expanding production here? Well, if the tariffs stay in place, maybe it makes sense. But if they're going to go away, all of a sudden you may have less expensive foreign competition again. It doesn't make sense to have that investment. So I think on the business side, things are kind of a wait and see. On the consumer side, unfortunately, we've got mixed signals. Consumer spending is still relatively strong. Even with the negative GDP numbers for the first quarter, most of that was driven by the huge increase in imports that we had because, that difference between our imports and our exports is a drag on our economy. But folks were trying to order as many of those imports as they could before a lot of these tariffs were to take place or are scheduled to take place. So that may be a temporary blip, but consumer confidence, consumer sentiment, which is, how they feel about their own personal financial situation and how they feel about the national financial situation are unfortunately taking nosedives. And it becomes a self-fulfilling prophecy. If you and I as individuals are worried about the future, what do? We cut back on our spending. And we're starting to see some of that in areas like jewelry and watches, on dining out. Some of those things where we have some flexibility in our spending, we're starting to pull back a little bit. For us individually, that's a good thing because our savings start to go up. We're putting together, building up our nest egg again. But collectively for the country and for GDP, that's not a good thing because if we're not spending, then the economy's not growing. With the potential government cuts, again, in the short term, it's going to be painful because by definition, reductions in government spending are contractionary. I don't think many folks would argue that the federal workforce is not bloated, and maybe there needs to be some trimming there. But we also have to acknowledge that by itself is contractionary. If you have these folks that had been working and are no longer working, that is going to have a contractionary effect on the economy. And so I think that's where you see bankers concerned is, are my consumer customers going to be able to continue to pay me? And we're starting to see not a little bit of increases in defaults, but definitely a huge increase in the number that are making the minimum payment on their credit cards. That's the first step before they stop paying those credit cards, or they're making less than the minimum payment. You've got the resumption of student loan payments, which, depending on the source that you're looking at, it's going to be somewhere between $250 and $500 a month. So all of a sudden, folks that maybe thought under the previous administration their student loan was going to be forgiven, it's no longer going to be forgiven, and they're going to have to start making those payments now. So that's going to be, I think, a strain on the consumer side. And again, on the commercial side, a lot of it is because of the uncertainty, we're going to sit on the sidelines and wait right now.
So uncertainty, the tariffs. Let's talk tariffs a little bit. What are your thoughts there?
Well, first, let me ask you this. Hopefully you'll see where the thread ties together here. If you're a sports fan, whatever sport you're watching, for me, it's generally the NFL. I yell at the TV when they make a bad call. And so it drives my wife nuts that it's the same thing when they say things that are just factually wrong about economics on TV. She reminds me that they can't hear me, but it's a little cathartic for me. It allows me to express that frustration. And so, one, just to be extremely clear for everyone that's listening and watching, tariffs are a tax. They are a tax on the importer. The foreign countries or the foreign manufacturers do not directly pay the tariff. Those goods come into the United States, and customs collects the tariff from whoever the U.S. importer was. Now the question is, effectively, who's going to pay that? Well, there's three possibilities. The exporter could lower their price some to offset some of the increase in cost to the importer. The importer could absorb some of the cost, and or it's passed on to the consumer. If you have tariffs of 145%, for example, there is no way that the exporter can absorb all of that cost. The importer isn't going to, increase their price by a factor of 150%. So guess who gets to pay it? You and I. So the concept that the U.S. Treasury's coffers are going to be filled by foreign countries is just not economically factual. Now, if overall tariffs are a drain for everyone, and so again, we can have tariffs on other countries. Other countries are going to have tariffs on our goods. At the end of the day, it's a strategy of who suffers the least. Can the U.S. survive a trade war? Absolutely. We've got the largest, strongest economy in the world. Are we going to suffer because of it? Yes. We'll suffer the least. But my economic opinion on this is any strategy on who's going to suffer the least economically is not a great strategy. You want everyone to benefit, and we want to benefit the most. We don't want to necessarily suffer the least. Folks are concerned about trade deficits. And are trade deficits bad? Not necessarily. Here in North Texas, I like to say I have a trade deficit with Whataburger, H-E-B, and Buc-ee's. So in the Midwest, it'd be the equivalent of me having, a trade deficit with White Castle. I've spent a lot more on sliders at White Castle than White Castle has ever given to me. And I'm okay with that. Trade deficits are not necessarily bad. When I was a teenager, I used to change the oil in my truck. Why? One, because I had a lot more time available to me. Two, my time was not nearly as valuable in terms of, being able to earn income versus the leisure time that I had. And I was able to, at that time, staying at your parents' home when you're a teenager, could drain the oil into these empty milk jugs that then just kind of sat around the garage forever because I couldn't bring myself to just throw it in the trash or dump it. Today, why do I go to an oil change place? Well, because they're the specialists in it. My time could be better spent doing other things. And again, specialists, they can drain the oil quickly. They can dispose of it properly. All of that good stuff. So just imagine if the government said, we want to encourage everyone to start changing their own oil, and there's now going to be 145% extra tax on oil changes. For a lot of folks, they're going to be forced to, they can't afford it. They're going to have to start changing their own oil. other folks are just going to end up paying it. It's not going to make anything better, but it just increases the cost for everyone. And so at the end of the day, all tariffs end up being not a zero-sum game, but a negative-sum game, because we as consumers are going to end up paying more for less. Now, some of the arguments, it makes absolute sense to strategically have tariffs. We found out during the pandemic that we are susceptible in particular areas on things that we don't produce in the United States and that we rely on foreign countries for. So one of the big shortages we had for a while, you remember, were the masks, and making sure that we had the proper types of masks, to combat the coronavirus. But we found other things too. And so does it make sense maybe to have strategic tariffs in terms of steel and aluminum? Perhaps. Does it make sense in terms of certain pharmaceuticals so that we can have those things here? Yes. Does it make sense that maybe we invest more in producing semiconductor chips in the U.S.? Absolutely. Does it make sense for us to necessarily be where they manufacture iPhones? I don't think so. And, it's been estimated that iPhone, rather than being $1,200, is now going to be $3,200 if we bring it to the United States. We have a integrated world economy, and to all of a sudden become completely isolated from an economic perspective makes no sense. And there are certain things that we simply can't produce in the United States. I've got a sweet tooth and I love chocolate. Guess what? We can't produce any cocoa here. Lots of folks love their coffee in the morning. Now, outside of Hawaii, we can't produce coffee in the United States, and Hawaii can't produce enough for all of the mainland. Not a place in the U.S. that you can grow bananas. So some of those types of things we simply don't have here. We could go into the rare earth metals and all the other types of things. So strategically, does it potentially make sense in some areas to have tariffs? Yes. From an economic perspective, does it make sense to anger your neighbor to the north and your neighbor to the south, and everybody hates you? I'm not sure that's the best economic policy. And again, I look at these things through an economic lens, not through a political lens. So if it's a long-term negotiating tactic, etc., okay, I'll take you at your word at that, but that's not my view on it. My view is, from an economic perspective, it doesn't make any sense in most cases.
So Bill, let's dig into this a little bit more here. So President Trump says that it's okay if Americans feel a little bit of pain to right some trade wrongs and some unfairness out there, and create financial incentives for more onshoring of investment and jobs, and that will increase revenue, in the form of direct tariff revenue. That it'll that increase in revenue may allow for a income tax decrease, which, or at least certainly not an income tax increase that we might have had if Trump didn't win this election. And the revenue source without an income tax increase will go a long way to buttress social welfare programs. So it's bringing in revenue sources. And then the idea is, of course, Scott Bessent's concern is refining $9.2 trillion of debt this year. $6.5 trillion or something like that needs to refi in June. So how do we get interest rates lower? And that discussion that's out there as well. So President Trump says, hey, these things may cause some pain, but we've got long-term gain with this. And Trump referenced again something like, we just have to suck it up. President Xi from China referred to it as that the Chinese will need to eat bitterness. So it's their cultural way of saying the same thing. And I think a lot of people outside of the U.S. say that Americans are soft and we don't have the same tolerance for long-term pain as the Chinese may have more tolerance through their, leadership structure, that their people can be forced to eat bitterness longer than Americans who have a vote and a voice will be willing to voluntarily eat bitterness. So background thoughts on that. The tariffs are one piece, and people say, well, if you look at tariffs alone, that's the component. But if you look at tariffs, there's the pain alone. But if you look at the rest of Trump's policy and you say, But what if we reduce regulatory burden and we get back to increasing energy production that, lowers energy costs, puts more money in consumers' pockets. And, if we look at those things, energy costs, a lack of a federal tax increase, those things offset and maybe neutralize the pain of the pain of tariffs. So it makes it easier for Americans to suck it up and deal with pain longer. Thoughts on that?
Well, there's a lot of things going on there, and let me just preface it as I mentioned before. I look at these things through an economic lens, and so one slide that I typically have when I give economic update presentations is it's not politics, it's math. So let's just see how the numbers might add up. So if we just look at what the government actually collected in tax revenue in calendar year 2024, and we look at individual income tax, which makes up approximately 50% of the, $4.9 trillion in tax revenue that was collected, versus what was collected in terms of customs, which was well under 2%. To match the amount that we collected in 2024 of personal income tax, we would have to collect 620 or 6,200%, a 62-fold increase, 6,200% more in tariffs. If we take it to a certain logical extension, let's say, yes, we're going to bring all of these manufacturing jobs back to the United States, and we are going to be completely self-sufficient, and we don't have to import anything anymore. Kind of at the end, that's the ultimate dream, right? All the jobs are back in the U.S. Well, if there are no imports, there is nothing to put a tariff on. And then we are back to having an income tax. If we were to switch them out, at the end of the day, it's still you and I that are paying the tax, whether we pay it in the form of a tariff or whether we pay it in the form of income tax. And so, again, the idea is that it's the foreigners that are going to be paying us these tariffs is just wrong. It's not correct. That's not how it works. Now, one thing you'd mentioned, wonderful thing that the administration started out with was regulatory relief on the banking side. Bankers are happy and they're happy now and hopeful that we'll completely get 1071 under control, that 1033 might be going away, that there's some relief on the revisions of the CRA, that there's some relief on the new rules on broker deposits. All of that has been, I think, very good news for community bankers. So believe me, it's not. I'm not a basher of all of the policies. Some of them have been very good, but what takes the headlines, or what makes the headlines, are these other types of things that they're doing. You'd mentioned that some of these things, the nice part is it might help spur additional energy production and bring down energy prices. Now, what the administration forgets, though, is that those are trade-offs, because as we bring down energy costs, there's less incentive for the energy producers to produce more. They like to pump that oil out in the Permian Basin when it's at $90 a barrel, not when it's at $50 a barrel. Now, can they break even? Yeah, $50, $60 is a break-even point for a lot of them. And they'd much rather have it at that 90, a lot more incentive. So you have these trade-offs. And in economics, nearly everything has a trade-off. So you can't look at just the benefit without also considering the cost. One of the things that you had mentioned, for example, is we're hopefully having some of the manufacturing back here. We're going to bring some of the jobs back here. Some of the evidence that we've seen from the past, in 2009, the U.S. imposed a 35% tariff on tires imported from Japan. And that saved about 1,200 U.S. tire manufacturing jobs through 2012. It cost us $1.1 billion in tariffs for those 1,200 jobs, paying $40,000 a year. So the cost was $917,000 per job. The benefit was $40,000 per job. So we have to look and see, does that make sense? In 2018, when the steel and aluminum tariffs were put into place, it saved an estimated almost 34,000 jobs in the United States in the steel and aluminum industries. but it costs nearly 180,000 jobs in other industries that relied on that aluminum and steel that went out of business because of those higher cost structures. If you remember Ben Stein's iconic character in Ferris Bueller's Day Off, right? He's the economics faculty member there at the high school, and he's giving his lecture, and it's, anyone. What's, I think, from an economist perspective that was funny is he's talking about the Smoot-Hawley Act of 1930. And the Smoot-Hawley Act of 1930 did very much what the president's tariffs are doing now. We're going to be isolationists. We're going to charge these huge tariffs on anything that we're importing so that we only buy domestic. Well, we know what happened from 1930 throughout the rest of that decade is we had, of course, the Great Depression. And in hindsight, the Smoot-Hawley Act is one of the contributors that made it much longer and deeper than it needed to be. And so just because we had done this before, one doesn't mean we should do it again. And we should learn from history. We saw how that movie ended. The sequel's not going to end any better in terms of not Ferris Bueller, but having lots and lots of tariffs on everything.
But I think the key point is you can't look at it just one data point, and you can't look at just one issue. You have to look at it as the other policies, as the other moving parts outside of the U.S. and inside of the U.S., tax policy, regulatory policy, all kind of are hitting at the same time and shifting at the same time. So if you're a banker and you've got all of these things, a lot of the community banks that we work with in the Midwest specifically, they're under $1 billion in deposits. The bankers are in everything. They're in ALCO meetings. They're grilling burgers in the parking lot for the Client Appreciation Day, right? They're on the school board. They're on the hospital board. They're in HR meetings. They're in everything. What advice do you give those bankers to filter all of these different perspectives and this noise out there?
Well, I think what's really important for community bankers, and I think community bankers understand this. Texas has more community banks than any other state. Illinois is not far behind. And in fact, if you were to just look at a map of the U.S. and go up the I-35 corridor and include Illinois, you've got over 40% of all the community banks in just those 8 states right there. So from Texas all the way up to Minnesota, like I said, you also include Illinois because it's not on I-35. You've got right in literally the center of the U.S., you've got the plurality of the community banks. And as you pointed out, those community bankers understand their community. So you have these huge macro issues going on. But for a community bank, those are important, but even more important are the microeconomic things that are happening within their community. So if you've got businesses that aren't going to be impacted much by tariffs, then those bankers are going to be pretty comfortable. It's not from a regulatory perspective, but just from a relationship perspective, know your customer. Now, if you've got builders, are they going to do better or worse? Again, I think the answer is it depends. It depends on what part of the country you're in. If you're in parts of Texas, we still have 400,000 people a year moving to Texas. That's over 1,100 people a day, and those folks need places to live. And so if you're building in certain parts of Texas, fantastic. If you're looking at other areas of the country, builders aren't so excited about putting up single-family homes right now, even with the higher rates. So it's know your local economy, know your local businesses. Like you said, the community bankers out there having coffee with these folks, and they get a feel for, things are looking pretty good. We really haven't been affected by this. While you've got others that might be saying, oh my gosh, one of our key inputs into our manufacturing process here in our factory in I'm just making this up, Muncie, Indiana, is, comes from pick your foreign country. And now we have to pay a tariff of X picks your percent, 25%. That's something that they're going to be concerned with. And is that going to impact their ability to repay the loan? So I think for community bankers, they understand that, and they're focused, hopefully, much more on that true local picture, and unless they've got a huge national company that has a presence in their local market, then they're going to be much more concerned with what's happening at that local level as compared to necessarily happening at the national or international level.
How does the Graduate School of Banking help community bankers stay focused? That was good advice. Know your customer, know your local market, but how does it help them stay focused and be ready for the future? And there's a lot of change in the future. Cryptocurrency, is one thing that we didn't even touch on. But that's a whole other discussion. I'll just leave it at that.
Well, I'll give you my 30-second comment on crypto. I teach my MBA students, or would teach my MBA students every night, value of any assets, the present value of all future cash flows. Everything in finance revolves around that. So if you look at crypto, there are no cash flows associated with it. And so therefore it has no value. It's the equivalent of digital Beanie Babies. Beanie Babies had lots of value for a while because folks wanted them until they didn't. And I think that's going to be, the future of crypto. Now, I've been proven wrong for many years now. Do I have some jealousy that, gosh, I wish I would have put $1,000 in crypto 10 years ago, and then I'd be, wealthy beyond all dreams right now? Sure. But, I would love to have that winning lottery number when it's up there in the, $500 million. So that's not going to happen. But what do? We stay current in terms of what's happening. If there are issues that bankers need to know, we're out there, either directly in class or myself, for example, out there speaking at a variety of conferences. In fact, next week, I'll be at the Windy City Summit in Chicago, big treasury conference there, giving my economic update and letting those folks know, okay, here are the things that are on the horizon. This is how it might be affecting you. So as I mentioned, with our SWGSB students, what do you really need to know about AI and banking right now? You've got that. In this case, it's an elective that they can do. And similar type things with our bank director programming is, what? We've got regulators and ex-regulators on our board of trustees. They've got their finger on the pulse of what the current regulatory environment is. We're going to let you know what these folks are thinking so that you can stay on top of it. And not that any community bank is going to do the crazy things that, SVB and First Republic and some of the other players did a couple of years ago. But to understand that, one, don't make those types of mistakes, and two, the regulators are going to be looking at some of those areas a little bit closer now.
Bill, one more quick topic for you. The credit union space. President Trump has termed 2 NCUA board members, and there's some discussion amongst credit unions that their tax status isn't as secure as it was a year ago. Do you have any thoughts on that? What's happening from a government policy perspective around credit unions?
Along that area, I'll say that the area that has me concerned is credit unions purchasing community banks. And not that I'm opposed to, a community bank being bought, but what becomes troublesome is if you have a tax-exempt organization being able to use some of the financial benefit that they have by being tax-exempt, then buying community banks. And so I've heard it suggested, and I don't disagree with the thought that if a credit union wants to buy a commercial bank, that's fine, but they lose their tax-exempt status. I think from a practical perspective, if we go back to the origins of the credit union and why they had that tax-exempt status, is that they were, for the most part, relatively small, and that they truly served a local niche community. And so for so many credit unions now, the common bond requirement is simply, do you have a vowel in your name? Well, then you can join our credit union. It's not quite that bad, but, do you live, work, or worship in a county that we have a presence? Well, again, that's not much of a common bond anymore. And so I think if we get back to that in terms of establishing those that would qualify for that tax exemption. I'd mentioned my predecessor, Jeff Schmidt at the Kansas City Fed. He had mentioned before that his thought was it'd be great if, and you can pick the right number, is it 500 million? Is it $1 billion? But any financial institution, let's just say under 500 million, is tax exempt. And once you get above that, well, then you're going to have to pay taxes. Now, I don't know what the magic number is, but when you have credit unions that are $20 billion, I'm not sure that they fit the mold of what The original thoughts were, when we granted tax exemption to credit unions, is that they were relatively small, made it hard for them to compete against the banks. And now they've gotten larger than, some of them at least, have gotten much larger than our average community bank, and they have this huge financial advantage. So I don't have the perfect answer, but I do know that there's no longer definitely not a level playing field for our community banks versus the huge credit unions. And again, I think there's still a special place for credit unions. When you see a little credit union that's $25 million, that's literally serving its little community, I think that's fantastic. But there's a lot of examples of very, very large credit unions that sure do look like a bank. And so if they look like a bank and walk like a bank and act like a bank, should they be taxed like a bank?
Gotcha. Well, we work with banks and credit unions, as you know, and we work with great bankers on both sides who work in banks and in credit unions. And I appreciate your perspective on that and your thoughts on it. I think the last few years, bankers have felt on the defense because of the credit union acquisitions of banks. And I think this year, credit unions feel on the defense because of some of those things. So it's a changing regulatory environment. Again, more uncertainty, and all the more reason that we've got to stay sharp. We've got to keep investing in ourselves and our people, and having opportunities to go to schools like yours to make sure that we're growing ourselves and our people as well as we possibly can. So as we sign off here, what is the best way for our audience to learn more about you and your programs?
You can just go to it's www.SWGSB for Southwestern Graduate School of Banking. So SWGB.org.
Awesome. Well, thank you very much, Bill. I really enjoyed our conversation, and you're a wealth of knowledge. So thanks for sharing it with me and our audience here. On behalf of all of us at Midwestern Securities and Banking on Growth, to you and our audience, thank you for being with us, and until next time.
Well, thank you very much for the opportunity. We had a great time.
Thank you, Bill.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.